think the reality, Dan, is that in volatile macroeconomic conditions, we're all looking for stable input costs to our business because we need to run our businesses. We need to know exactly what it's going to cost us to run our operations. And you've said this many times before, and I really like it. The reality is we can't control too many inputs to our business, but energy is a lever that we can certainly control. And being able to really have a disciplined insight into what our energy costs could be and should be is going to be a key driver. And so I think the real takeaway for me is it's really important that we are constantly optimizing around the market conditions, and we're really truly understanding what are the critical inputs, how does that impact our outputs, what is the economic optimization doing for us, and let's ensure that we're making the best return on investment decisions. Welcome back to Renewable Rides. Today we are going to cut through some tariff turmoil and market mayhem. And we're going to talk about the real story of on-site energy economics. There's a lot of dramatic headlines in the market. There's a lot of doom and gloom. But today we want to dig into what impact will the tariffs actually have on energy projects, and how do we actually use this volatility as an opportunity to really drive the deployment of more reliable, affordable, and secure energy outcomes at scale. So Dan, excited to dig into this one today. It's been bonkers the last few days, seeing how this has rolled out. We're recording the morning of April 8th, and it seems like these change by the hour, by the day.
It has been quite a wild ride. I've watched the bloodbath as we closed out last week, and then it was nice to see a bit of a recovery yesterday and coming into today. So I've been pleasantly pleased with some of the analysis that we've done and how we're gonna dig into today, because the news isn't as dire in the on-site world as maybe the public markets are reacting. So eager to get after it, Gareth.
Yeah, well, do you want to give us a quick recap on what's happened in the tariff market and how we've ended up where we are?
Certainly. So really, like you said, I mean, it's been a bumpy last 4 or 5 days. There's been a ton of tariff action since the new administration took office back in January, and really too much to cover in this particular episode. But really, what happened last Wednesday, April 2nd, was really shook the capital markets. So on April 2nd, we saw the long promised, quote, reciprocal tariffs were announced, really a 10% baseline tax on imports from all countries, as well as higher rates for dozens of nations that run trade surpluses with the U.S. Some of those steeper tariffs were across 34% tax on imports from China, which was on top of the existing tariffs there, 20% on imports from the European Union, 25% on South Korea, 24% on Japan, 32% on Taiwan. And then those new tariffs come on top of the 20% that Trump had previously announced on all Chinese imports earlier this year. So meanwhile, the goods from Canada and Mexico, the White House says that as long as they are USMCA compliant imports, they can continue to enter the U.S. duty-free. And once those two countries have satisfied Trump's demands on immigration and drug trafficking, the White House believes that they will remove the tariffs on imports, or drop those tariffs, from 25 to 12%. Now, all of this last Wednesday created quite the chaos in the capital markets, and it drove the S&P 500. We saw a 14% drop from Wednesday evening or Wednesday afternoon closing through to yesterday, Monday morning's opening, or a little after opening at 9:30. And luckily, we've recovered somewhere in the range of a 7% total drop. So things are starting to look up. We'll see. I think some of the either willingness to negotiate and retaliatory tariffs is something that we're going to see a lot of movement here in the coming weeks. But Gareth, that has resulted in a lot of questions from our customers and prospective customers and just the market in general around how are all these tariffs going to impact project economics. And so maybe you can start us off before we get too deep into some of the analysis that we've done. What drives, outside of just the equipment, what drives project economics, and how should we be thinking about it?
Yeah, it's a great question, isn't it, Dan? Because I think gut instinct would say the biggest driver of project economics would be construction and equipment. But actually, based on running thousands and thousands of analyses, we know that that's not the case. And so, in order of their impact on project economics, it starts with utility tariffs. And obviously how we consume energy today, our baseline utility tariff and what we pay for energy from our utilities is the biggest driver to project economics. And this is both today's as well as the projection into the future. Our customers typically model anywhere from 3 to 8%. I think based on the market dynamics, we've seen 6 being a realistic escalation factor. That's been the trend for the last 4 years. And so we know that these rates are on an inevitable trajectory rise based on the rising demand, the aging condition of the grid. We talked about this in our last episode, so I won't go into it in any more detail on that. But obviously, the more those utility tariffs go up, the better we can realize in terms of commercial gains through deploying an on-site energy system. The second is around energy consumption. So if we can modify our energy consumption to ensure that we reduce our peak demand and that we're not consuming energy during high time of use tariffs, these can have real big impacts on the economics of a system. And then I think the third area that most people don't think of, but NREL did a study several years ago, and they found that under the traditional consultant and developer model, between 30 and 70% of project costs are what we call soft costs. And these are consulting, engineering, procurement, contracts, negotiation, all the logistics that goes into planning these projects, the origination of deals, the sale of deals. And that's a huge percentage of the project cost today. And that's a big reason for why we exist, is to slash those soft costs out of the market through automation and orchestration of projects. But that makes up a huge portion of project costs today. Then we get into the incentives, and this has obviously been up for debate as well. Here in the US, we have the Inflation Reduction Act and the ITC. That gives us at least a 30% tax credit on projects today. This is a huge bump to projects. It takes borderline projects and makes them great. It takes great projects and makes them incredible. And so the incentives certainly help, but we don't rely on these. We ensure that customers are developing projects that are justifiable and have positive returns with or without those incentives. And I think the real key is to understanding where are those projects located. Increasingly, we're seeing sixth on the list, outages and resilience. This has the ability to actually skyrocket up this order and become 1 or 2, I'd suggest, because the cost of a power outage can be so significant to a business that it can outweigh all other factors. I'd say this trend is starting to build, and I think we're going to see a lot more of it. But today, it's 6th on the list. 7th is the financing structure for projects. This is how we actually finance projects, whether that's debt financing, self-financing, energy as a service. We want to make sure that that's tailored to a business's needs and objectives. Obviously, the cost of that financing structure can have a significant impact on the project economics. And then we get to equipment pricing. And so this is super interesting, isn't it? Because there's a lot of noise about how is the equipment pricing going to impact the economics of these projects. Today, equipment makes up approximately 30% of the overall costs of a project. And what we've seen over the years is typically a 3 to 8% reduction in the cost of equipment year on year as a result of us producing more products, deploying them at scale. And so we'll continue to see that trend as the technology matures. But what we did was we looked at all the subcomponents of a solar and storage system. And for a solar and storage system, there are over 50 different subcomponents. And these can be the panels themselves, to the racking, to inverters, to the actual logistics of getting it there. And we looked at where do we typically source these components from, and what are the likely tariffs that they could incur under the current structure. And so even though the headlines are saying 25, 30+% tariffs, when you actually break it down and you look at where are all these different components going to be sourced, we actually believe that the cost increase impact for equipment will be approximately 11.16%. So we're going to see an 11% increase in equipment prices as a result of the current tariffs. So you can see it's not as big as what you may be led to believe. And then we've spoken to some of the major distributors in the market, and they've said that it's obviously hard to predict how this will play out, but there's been many manufacturers that have already been bringing equipment in en masse to the US in preparation for the tariffs. We also see manufacturers who are willing to absorb some of the tariffs to drive increasing sales volume. And the reality is, we have a buffer here to deploy good projects, not have too many negative impacts from the equipment cost rises. And then last on the list is construction costs. These typically make up less than 20% of the overall project costs. They're obviously not going to be impacted by the tariffs, but I think it's super important to understand what are all the inputs to the economics of the project. And in particular, equipment and incentives can have an impact, but let's dig into how big of an impact. And so, Dan, we ran some really interesting analyses, and I'd love for you to talk through the scenarios that we looked at and the outcomes.
Really appreciate that breakdown, Gareth. And I was very appreciative of our team that spent time kind of as the last week closed out and over the weekend running this analysis so that we can be able to share it with the market. So first, I'll share one of the things that we always take a look at, and you mentioned at the very beginning, as far as the primary driver of the economics of these systems being the utility tariffs, both now and in the future. And I think that's a key component as we talk about this. For this particular analysis, we ended up going, we see our customers somewhere in the 3 to 8% annual utility escalation range is what they ask. For this analysis, we did a 6% annual utility rate escalation. And we find that both supply chain costs and the tariffs create upward pressure on utility prices, as well as the aging grid infrastructure that we spoke about in the previous episode on the D+ rating across the grid. On top of that, we've seen across commercial rates over the last 3 years a 6% increase across the U.S. and industrial rates an 8% increase. So for this analysis, we went with a 6% increase because all of these factors are going to continue to drive those increases in the future. And so we really ran 4 core scenarios. The first I'll call our control, which is equipment costs remain the same. These tariff announcements that came out last week aren't actually going to happen, and that the investment tax credit remains intact. I think that's an important one because there's been a lot of noise around the Inflation Reduction Act going away and those tax credits going away with it. So we wanted to include that in some of the scenarios that we looked at. So the control is equipment costs remain the same, are not impacted by tariffs, and the investment tax credit remains intact. Second scenario is equipment costs increase, that 11.16% that you mentioned due to the tariffs, and the tax credits remain intact. Third scenario, equipment costs increase the 11.16%, but the tax credits go away entirely. The fourth scenario was that equipment costs increased 30%, so nearly 3x what we believe that is going to happen with these tariffs that were announced, which is highly unlikely, but let's call it a worst case scenario, and the tax credits go away. So what did we find in this? Really what we did is we looked at a large supermarket chain. We looked at 200 of their stores as well as a couple of their distribution centers. And candidly, I was pleasantly surprised that when we look across scenario 2 against the control, so just the equipment cost increases due to tariffs, that it has a minimal impact on the net present value of this system. Really, it went from across the portfolio $242 million of net present value to $225 million of net present value, only a 7% reduction. And that was even with the 7.7% increase in CapEx of those projects. I will note that our optimization engine is optimizing for net present value. So you'll see that as we talk through some of these results, what the optimizer does is it it looks at the market conditions that we apply to it and says, what is going to optimize? What's the system that's going to optimize for the highest net present value? So as we increase the cost of equipment, as we eliminate tax credits, we'll see the solar and battery energy storage sizing come down in order to preserve as much of that net present value as possible. So as we move into the scenarios 3 and 4, and we remove the tax credits, and in scenario 4 we increase the equipment costs even further, we see that CapEx comes down and it preserves the NPV as much as possible. In scenario 3, CapEx came down nearly 33%, with the solar sizing dropping 35% and the battery energy storage sizing dropping 84%. Yet the net present value only dropped 27%. So that it was able to preserve it. It is a drop, and we see that, but we're optimizing the system again here. And then in scenario 4, with 30% equipment cost increase and no tax credits at all, we still see it has a $135 million net present value. That is a 43% decrease from our control case, so a pretty significant decrease. But it is 52% less solar, 92% less battery energy storage. And one of the things that I do appreciate in all of this is when we see the CapEx come down and we look across the life of this system, the internal rate of return, or IRR, which is a really valuable metric, is largely preserved in most of the cases across this portfolio. Still remained in the low 20s, even with all these massive market changes. So what are some of the pieces that you took away from this, Gareth?
Yeah, I think the reality, Dan, is that in volatile macroeconomic conditions, we're all looking for stable input costs to our business, because we need to run our businesses. We need to know exactly what it's going to cost us to run our operations. And you've said this many times before, and I really like it. The reality is we can't control too many inputs to our business, but energy is a lever that we can certainly control. And being able to really have a disciplined insight into what our energy costs could be and should be is going to be a key driver. And so I think the real takeaway for me is it's really important that we are constantly optimizing around the market conditions, and we're really truly understanding what are the critical inputs, how does that impact our outputs, what is the economic optimization doing for us, and let's ensure that we're making the best return on investment decisions. Dan, I think would love to get your takeaway to bring us home.
Yeah, I think amongst the chaos, my fears are tempered, I guess, when we look at the macro trends, and really they're inevitable. Yeah. Energy costs are going up. Power reliability is going down. And as a result, more businesses are demanding on-site energy, yet they run into challenges. And the key for them is to not be paralyzed by, analysis paralysis or just the market chaos and noise, but to continue to make data-driven decisions surrounding, location-specific insights and analysis, and run scenarios for the changing market conditions. But really being able to scenario plan and optimize these systems is the key to successful deployments. And the beauty of on-site energy is that they are modular in nature. Yeah. We did recently have a customer that was considering solar with batteries and decided to have the EPC deploy battery-ready switchgear on the system because they weren't ready to pull the trigger on batteries today, but they expected to sometime in the future. And so with that in mind, we can deploy the optimal system based on today's conditions rather than trying to project too much into the future of what's going to happen, and then develop them further and modify them further as the conditions change to ensure that the system is always delivering the best possible economics that we can have. So with that, let's hopefully, we'll see in the coming weeks how these tariffs play out. But the good news is it doesn't actually impact the project economics too much when optimized correctly and done right. So we'll likely pick up another episode here in the coming weeks and months to reflect back on this chaotic time.
Love it. Great insights. Thanks to you and the team for the analysis.
Of course. Take care, guys.
We receive a lot of questions from business leaders around the world wanting to learn more about the energy transition.
what is possible, and where to start. So to help you stay informed and up to date on best practices, opportunities, risks, and success stories, we created an industry newsfeed at VECKTA.com/news with all our podcasts, blogs, and newsletter. Check it out and connect with Dan, myself, and the VECKTA team to learn more. Cheers and have a good one.